Welcome to the final part of candlestick patterns. Here we will discuss about some advanced patterns of multiple candlesticks, which can help us in understanding price actions and trends in any chart. Abandoned baby. It's a reversal pattern and similar like morning and evening star. The bullish abandoned baby formed during a downtrend. The first candles is a red bearish one, then the second one opens gap down and forms a doji. Finally, the third one opens at a gap up and grows up further, showing reversal to bullish trend. The bearish abandoned baby formed during an uptrend. Here the first candle is a green bullish one, then the second one opens gap up and forms a doji. Finally, the third one opens at a gap down and dips further, showing reversal to bearish trend. Counterattack candlestick patterns. These are reversal structures involving two candles in the opposite color but close at the same price. A bullish counterattack candlestick pattern forms at the bottom. In this pattern, the first candle is red and the second one is green. The second candle opens after a gap down but closes at the closing price of the first candle. A bearish counterattack pattern occurs at the top. In this pattern, the first candle is green but the second candle is red. The red candle opens after a gap up but closes down near the closing price of the first green candle. Advance block. It's a bearish reversal candlestick pattern that consists of three bullish candlesticks. The first candlestick will be a big bullish candlestick. It can be a Marubozu. The big body shows the momentum of buyers pushing up the price. The second candlestick will also be bullish, but it will have a low body to wick ratio. It will open within the previous candle's range and close above the closing of the last candlestick. The third candlestick will have the smallest body to wick ratio compared to the previous two candles. It represents a pause in an uptrend. It is a single pattern that does not have an opposite pattern due to rare occurrences on the price chart. Stick sandwich pattern. It's a reversal pattern. The bullish stick sandwich forms during a downtrend. Here the first candle is red with a short lower shadow that represents a new low in the downtrend. Then middle candle is bullish green candle. The third candle needs to engulf the middle one, and also close near the closing of the first candle. Bearish stick sandwich pattern appears in an uptrend. Here the first candle is green, with a short upper shadow that represents a new high in the uptrend. Then comes a second bearish candle, which has opening and closing within the first candle. The third candle is green and has opening below the close of the second candle. It has the same level as the close of the first candle. Unique 3 river and mountain. Unique 3 river is a bullish reversal pattern. First long red candlestick reflects the strong bearish pressure, while the second candlestick reflects the market indecision as buyers come in and resist sellers, resulting in a very short body. Third one is a green candle. Closing price below close price of second candle, indicating start of an uptrend or reversal. Unique 3 mountain candlestick is a bearish reversal pattern. This is a 3 candlestick pattern that somewhat looks like the bearish evening star. It appears in an uptrend. The first day's green candlestick engulfs the following small green body, which characteristically has a long upper shadow. The pattern is completed by a small red body, which closes above the close of the second day, indicating trend reversal. 3 inside up and down. The 3 inside up is a bullish reversal pattern that appears at the end of a downtrend and signals a shift in control from sellers to buyers. Here first candle is a strong red candle. Second one is a green candle within the range of the first candle. Then comes a large green candle that closes above the high of the first red candle. The 3 inside down is just opposite of earlier pattern. Here, first candle is a strong green candle. Second one is a red candle within the range of the first candle. Then comes a large red candle that closes below the low of the first red candle, indicating reversal of trend to a bearish one. 3 outside up and down. The 3 outside candlestick pattern is a reversal pattern that is used to indicate a trend reversal. Here, first candle is a red candle. Second one is a fairly large green candle outside the range of the first candle. Then comes a green candle that closes higher than earlier both candles. The 3 outside down is just opposite of earlier pattern. Here, first candle is a strong green candle. Second one is a fairly large red candle outside the range of the first candle. Then comes a large red candle that closes below the low of the earlier both candles, indicating reversal of trend to a bearish one. Rising and falling window. The rising window is a bullish continuation candlestick pattern, characterized by a gap between two candles, indicating strong buying pressure and potential for further price increases. The falling window is a bearish continuation candlestick pattern, characterized by a gap between two candles, indicating strong selling pressure and potential for further price decrease. On neck, it's a two-bar bearish continuation pattern. For bullish on neck, during the first period, price continued the pre-existing uptrend. The second period opened with a modest gap up, but price moved back down, filled the gap, and closed at the same price as the first period. It shows the bulls are still active on the closing of earlier period of green candle closing. For bearish on neck, during the first period, price continued the downtrend. The second period opened with a modest gap down, but price moved up, filled the gap, and closed at the same price as the first period. It shows the bears are still active on the closing of earlier period of red candle closing. Hikkake, it's a reversal pattern. For bullish Hikkake, the first two candles are of declining size. These are referred to as an inside day pattern or a harami candlestick pattern. The body of the first completely overshadows the body of the second. The third candle closes below the low of the second candle. The next one or more candles will drift below the third candle and may begin to reverse direction. The final candle will close above the high of the second candle. For bearish Hikkake, the first two candles are of declining size. These are inside day pattern or a harami candlestick pattern. The third candle closes above the high of the second candle. The next one or more candles will move higher the third candle and may begin to reverse direction. The final candle will close below the low of the second candle. Deliberation pattern. The stalled candlestick pattern or deliberation pattern is a reversal pattern. Bullish deliberation pattern. Here, first candle is a long bearish candle that continues the existing downtrend. Second one is another bearish candle, usually with a smaller body than the first one, indicating that the downward momentum is slowing down. Becomes the third candle, a small bearish or doji candle, showing indecision among traders. This candle has a much smaller body than the previous two candles and often has longer shadows. Bearish deliberation pattern. At first there is a long bullish candle that continues the existing uptrend. Second one is another bullish candle, usually with a smaller body than the first one, indicating that the upward momentum is slowing down. Third candle is a small bullish or doji candle, showing indecision among traders. This candle has a much smaller body than the previous two candles and often has longer shadows. Tower top and bottom. Tower bottom occurs during a downtrend, indicating a potential reversal. The first candle is a long, red candle, representing bearish momentum. Then comes the sideways phase of small-bodied candles, which can be either red or green. These are signs of uncertainty and indecision. The last candle is a long, green candle, signaling the initiation of a reversal in the current trend. This bullish candle suggests a shift in market sentiment and the potential start of an uptrend. Tower top occurs during an uptrend, indicating a potential reversal. The first candle is a long, green candle, representing bullish momentum. The subsequent candles during the sideways phase are characterized by spinning tops, which can be either red or green. These candles reflect market uncertainty and indecision. The last candle is a long, red candle, signaling the initiation of a reversal in the current trend. This bearish candle suggests a shift in market sentiment and the potential start of a downtrend. Strat candlestick patterns. The Strat patterns are a set of specific price bar sequences used to identify trend directions, potential market reversals, and trade entry points in a multiple timeframe trading approach. There are a dictionary of Strat patterns, here citing only few as an introduction. The Strat strategy mainly revolves around three core candlestick types: inside, trending, and outside bar candlestick. While using these patterns, also use other indicators and volume as confirmations. In our further series, we'll discuss about volume analysis for better understanding. If you like this video, please like, subscribe and share this channel. Thank you.